Let me make sure the audio is working. Still not working? All right, let me double check it. How about now?
I'll come back to that at the end of this report. The statement says the committee will consider additional adjustments to policy
All right,
based
thank
on
you.
the data, the outlook, and the balance of risks. The summary of
Damn.
economic projections saying an additional 50 is expected or forecast by the median Fed member for this year, for a total of 100 this year. That would bring the median down to 4.4%, or an additional 50 basis points from where we are right now. Another 100 basis points of cuts expected through next year, bringing the rate down to 3.4%. All of that a bit above where the market is priced. And the new long run rate would hit 2.9%. That's up a tick by the year 2026. The statement now says the Fed is firmly committed to supporting both maximum employment and the 2% inflation target. Before and for many months before this, the Fed had relied solely on saying it was focused on the inflation target. The committee has gained greater confidence, the statement said, that inflation is moving to that 2% target, and risks to both sides of the mandate now are said to be roughly in balance. On the economic description, the economies continue to expand, it says, at a solid pace. Job gains, however, have slowed. Inflation making further progress towards 2%, but remains elevated. It's seen declining to 2.3% this year, 2.1% next year, and hitting the target 2% by 2026. Unemployment, the outlook for unemployment did tick up. I think that's important to what the Fed said here and what it did. Up 0.4 to 4.4%, 2 ticks higher than it is right now. Growth pegged at 2%, slightly above the 1.8 potential, well into 2027. Now, 9 officials in the dot plot wanted to do 75 basis points or less this year, and 10 wanted to do 100 or more. So it may have been a very close call as to what was actually wanted around the table in terms of 25 or 50 today, but they decided ultimately with 11 voting in favor of the 50 basis point rate cut. Tyler.
All right, Steve, stick around as we get back to our panel for some reaction. Claudia, you were the one who said 50 basis point cut, and that's what happened here. Clearly, maybe more emphasis on what's going on in the labor market than on inflation.
Right. This is absolutely a vote for the dual mandate. And so trying to protect maximum employment, things are good right now. They're not pointed in a good direction with the labor market, but that's why you get out ahead of it. So this is a risk management, and it's showing that the Fed is taking the risk on the labor market side very seriously. And that also shows up in the projections, right? They are trying to move. This is not the last cut. So it's a really important recognition of what we've been learning about the labor market, and the Fed is reacting.
So, David Kelly, they're opening big, and you think that another, you said that by the end of the year we would be 0.75 of a point lower than we are today. That would imply then that there would be 2 more cuts of 25 basis points, or at least one.
Yeah, no, I think we probably will get two at this stage. I mean, I would have preferred they went 25 basis points today. Obviously, it's a very close call in futures markets. But the important thing to recognize is that cutting interest rates at the start doesn't stimulate the economy at all. There is a J-curve effect. It actually slows the economy because people begin to anticipate those lower rates, so they want to wait for lower rates. It tells people that the Fed is scared about unemployment. I don't think they really should be, but that's the message it gives. So it undermines confidence. The reason I thought, bringing rates down from a high level is like, bringing a piano down as a flight of stairs. You've got to do it very carefully and very slowly. That would be the right way to do it. And I'm a little worried that they started off in a rush here. But I do think this economy is strong enough to deal with it. I think we will, next year, I think we'll get 2% growth, inflation 2%, unemployment close to 4%. So I think it's still a healthy, strong economy.
Does it risk it in any way, Jim, reigniting inflation?
Look, I mean, to some degree, it's certainly.
Okay, yeah, we've heard this talk over and over. Does it risk inflation? Wow, what a surprise, though. That was a so far positive surprise for the market. We're going to jump to the charts here. 50 basis point cut. Everybody was expecting 25. At least that's what the market was counting on. So that was a definite surprise. Is it positive or negative? Who knows? You know how markets are on Fed Day. Let's pull up the technicals here. See what we're looking at on Fed Day. You never know. You sometimes you get a downside spike and then we clear higher. Today we could get this upside spike and then literally just sell off for the rest of the day. So it's going to come down to that meeting. How does he pitch the cuts? But look, initially the market's moving up because cuts are positive for the market. We're getting that positive data. This week we had industrial production, which is the production side of the economy, at least on the goods sector, higher. So it was higher than expected. You get better production, you get better retail sales, better than expected. Still cooling, but not recession territory, right? Just cooling. So the economic data is not showing a big risk to the market, which is why we're seeing bonds sell off, right? We're starting to see bonds not sell off hard, but the momentum in bonds are, what is this? Hold on, I got a restriction on TikTok. They're always restricting. So yeah, bonds are selling off. TikTok, go ahead and just jump over to YouTube, and we'll see how it is. I know there's a lot of demand for treasuries. There's still a lot of demand for US treasuries, still paying a high rate. It's going to take a while. If we do get a stronger economy in the next 3 months, then US treasuries will probably just trade sideways. I don't think they really sell off. I think they'll trade sideways. Let me read this while we're going. Oh, I see. I see what it was. Okay. That's what that was. Showing the Fed meeting. Well, we got Powell in about 20 minutes, so we'll go ahead and jump through. We'll go ahead and jump through this data. Yeah, that was a surprise. That was a big surprise right there. 50 basis point cut. Let's go ahead and jump to, let's just look at the daily chart really quick. So we've had bonds, moving higher. Now they're pulling back, but you could still see we're in the uptrend. That trend might be over if the economy responds immediately. Now you have the S&P at all-time highs. S&P is breaking to all-time highs. This is the level I thought we might come down to. Doesn't look like we're going to get that. So far, you never know. The market is always repositioning itself defensively, positively. I want to see how the sectors in the market are responding, because right now we have this mix of defensive and cyclical stocks, right? Interest rate sensitive stocks that want those interest rates to come down. We have a mix going on. So this is the overall index. We're just looking at S&P. Nothing big, nothing too big. Everybody's going to try to parse this out, what's going on here, but definitely a surprise. 50 basis point cut. Let me see if the data showed up yet. Let's jump over here. See if that data showed up. Yep, it did show up. Nice. This is the Fed rates right here. Okay, first cut in 4 years, right? We go back. This was the rate increases for the while, ever since we had the pandemic stimulus. We had a lot of rate increases. We had a bear market. Not really a recession, but we had a bear market. So now you're getting that first cut with markets at all-time highs. It feels a little uncomfortable, being at all-time highs. What is this? Man, they got too many things going on here. Nah, I don't want to see that. So yeah, okay, nice. We got the data in. Okay, I'm glad that TradingView is actually showing the data. Sometimes it delays a little bit. And the question is, what are we going to see coming next? Are we headed for a recession? I really doubt we're headed for a recession here. There's a lot of stuff in the data that is pretty positive, right? But let's go through. Let's see what we got here. Let's go to the 30-minute chart so we can kind of get a look at the last 30 days. So this could be a top, right? Now, don't get too excited. I don't want to get too excited here. We got to wait for the actual meeting to see what happens. This could be just some hedging, right? Some call hedging that came out of the market. And if that is the case, this could be the top for the day. You never know. That all it tells you is that was a surprise. That was an upside surprise. The shorts probably covered. And we'll see what Powell says going forward. Really, I want to lean more positive because you're not getting the economic data, the business cycle, right? All the growth data, you're not seeing it turn negative. It's slow. It's very slow, but it is not turning negative. We can go through some of that data. I think I might got some of it up here. GDP on a year-over-year basis is climbing higher. All right. And you have inflation falling. You have the inflation rate, at least the year-over-year inflation rate, still falling, still has room to come down. That's a very bullish scenario. What do you think Powell's going to say? I don't know at this point. I was expecting him to be a little more conservative, but now that we have the 50 basis point cut, that tells us that he's definitely more concerned about the labor market. So, we're still going to be looking at the data here going forward. We still need to watch the data. He is concerned, right? 50 basis points going into the end of the year. Was that a political cut? I know people are going to have all their opinions on it. Either way, what does it tell us about the market? Okay, let's look at the let's see what the actual sectors are doing. I want to switch to the sectors. This is something new that I've been implementing to kind of get a gauge on the internals of the market, right? So far, 75% of stocks are moving higher. Okay, that's what we get with the 50 above the 50-day moving average. So you get some market breadth, right? It's been moving up. We'll see if this continues. We'll keep track of this. But high beta versus low beta. This is something I've been tracking too. And we're going to look at this. I want to see how these things react. All the different sectors, cyclicals, defensive, and some of the quality sectors, right? Quality stocks. How do they respond to this rate cut? How do they respond to Powell? So lately, ever since that Japanese carry trade blowout, we moved up, we came back down, and this is high beta stocks, high volatility stocks versus low beta. And high beta stocks are moving higher. They're anticipating, they're more sensitive to the rate cut, right? So they're anticipating more liquidity for that market. So that's pretty positive there. Inflation may, okay, yeah, we'll see what that says going forward. We still got some time. We're going down slowly from that SPY pop. That's what I thought. I thought we'd come down a little bit. But let's see these sectors. All right, so here we got S&P. We got the NASDAQ versus the Qs intraday. I'm going to go on the 1-minute chart so we can really see how thick that move was. I wish this would show us. I guess it's not going to show us. So the Qs actually trading lower. Well, let's go 5-minute. Let's go 5-minute. It's a little volatile here. So yeah, ever since we got the decision, the Qs are trying to kind of topping out here. So S&P is strengthening versus the Qs. This is NASDAQ versus S&P. All right. Bonds are starting. Well, bonds first sold off versus S&P. Now they're coming up. So we got the bond market strengthening a little bit, right after the cut. Bonds sold off. Makes sense. If they cut really quickly, they're going to reaccelerate the economic cycle. They're going to reaccelerate growth. And so the bond market's kind of selling off, right? The risk of recession is lower if the Fed cuts faster. I know people say, oh, well, they're scared. It's irrelevant. What's the real effect on the economy? You cut interest rates, people, home buying, we're already seeing new home sales spike, new building permit spike. We're seeing economic activity rise, right? So bonds are kind of selling off. I don't know. Bonds might be stuck here if the Fed is very dovish. Energy up. This is a surprise. Now, I don't know where this is coming from because China is very slow. So I don't know if the energy is that we see energy up based off of the actual cyclicals, because it is a cyclical sector, or if we're seeing energy up because of what's going on in the Middle East with a possible escalation. That could be the other reason, right? Okay, this is big. Materials. We're going to go over some of these stocks. So materials are responding very strong. Basic materials right off that Fed 50 basis point cut. That spells out economic activity to reaccelerate here. And I want to kind of go through some of those names, but we'll get back here. XLI. So this is industrials. They responded positively, coming down. Consumer discretionary, positive, coming down. Home builders, positive, coming down. Okay, this is good insight here for me, anyways. Real estate, it's kind of whatever, right? Financials, wow, that's interesting. Financials dumped on the 50 basis point cut. Didn't like it. IWM up, strong. We'll see if it holds on there. Consumer staples, my bad. I said staples earlier. That was discretionary. Staples down. Why? Because staples are defensive sector. So the defensive sector so far weakening after that 50 basis point cut, right? What does that tell us? If interest rates are cut, then usually should lead to lower yields and higher bond prices. ICE Blue, that is historically when the data rolls over. Yes. When you get cuts with the data rolling over, you are correct. But right now it's a weird time, right? Nothing has gone the way we thought. The SOM rule has triggered, no recession. The yield curve is negative for the longest of all time, no recession. So I think we have to look at history, use it as a gauge, but also kind of, use some nuance here. What is actually happening? Well, the rate cuts should allow bonds to go higher, but it's all about the data. Is the data slower? So look, defensive stocks are selling off. Staples are selling off at the moment, the sector, right? Maybe not all the individual stocks. So the defense trade is coming off right now. XLV, nothing's changing there for healthcare. XLU sold off all day today. So the strongest sector right now is basic materials, okay? Industrials, it's the cyclicals. I tweeted this earlier. The cyclicals are probably going to benefit the most. And now with the 50 basis point cut, you probably have a lot stronger materials. So let's go ahead and look up the material sector, see if these individual stocks are actually moving up like that. See. Where do I have it labeled as? Am I blind? Oh, there we go. Material. Duh. All right. I only have 4 of them in here in this basket. I was only looking at the 4 strongest. So Freeport McMoran exploding. 50 basis point cut allows them to do more financing, right? To increase their production of copper in the economic cycle coming ahead, right? This is the very, very upstream. This is very upstream when it comes to business. It is the basic materials and the resources. So basic materials up. Now, I'm not saying, hey, go trade this. I'm just, what is the picture? What is the picture that we're starting to see here? Newmont Corporation exploding, right? I mean, it doesn't move much on average anyway. It's not that big of a move. No, this is a big move, I guess. No, that's a big move. So the basic material, and there's other companies. I don't have a whole lot in here individually. It looks like Newmont and Freeport are exploding. I got to get some more in there. My guess is some of the industrials are also going to be moving up. They're hand in hand. They're both cyclicals. Should we go industrials or real estate? Home builders. Let's go look at the industrials. Caterpillar. Okay, Caterpillar had a nice response. I like Caterpillar over the next 6 months. Very dominant company. The technicals are beautiful. Let's see. That is Rail. Deere Company. Nothing too crazy here. Right? Nothing too crazy here. XLI. Yeah, those basic material companies are moving higher. What about SCCO? I should have had that in there. This is Copper Company. Yep. Here we go. Southern Copper. I've been talking about this for a while. Southern Copper moving up pretty strongly. And I think part of the reason is the basic material sector, we'll go to the longer term chart, has been declining, even though copper is technically strong, right? Let's turn on let's go ahead and look at this is a copper company, by the way. So this looks good. Look at this trend, right? You're getting a bottoming out for momentum. Momentum's starting to pick up here. And it's in the trend. It's still in an uptrend. This is SCCO, Southern Copper Corporation. It looks like copper. Okay, the trend basically looks like quash. Would you say, please check my question? What was your question? If interest rates are cut, that's a comment. Did I miss something? Ice Blue? Did I miss your question? Oh, is small caps up? Yes, there we go. I just saw that. Yeah, small caps are up. Small caps are up. IWM is, the most traditional way of looking at it. Small caps are up right now. They're exploding. Anyways, let's not spend too much time on this. Copper is moving up. Look at this trend, though. I just want to point out, very nice technical downtrend. I'll probably get long. We'll see how the Fed meeting goes, but this looks really good. And it's basically a reflection of what copper's looking like at the moment, right? And if we go to copper, see what gold's doing. Gold's moving up a little bit. That's more stimulus. You look at copper's trying to break out. So I think copper's bottom now. You got the bottoming pattern. Anything Newmont, Freeport, McMoran. Now they're going to be mining more copper, more silver, aluminum, whatever it is, steel. And that is all to get the economy back. So, man, wow. What a surprise, though. What a surprise. Okay, so let's look at IWM. IWM moving up. Pretty vicious rally. Pretty vicious rally there. Nice. I want to see SMH. I want to see how the Qs or how tech is responding to this. Everybody's up, but versus the S&P. So this is your small cap index right here, moving up. We got about 10 minutes before Powell comes out. We'll try to understand what he's saying. I think it's irrelevant. I think that 50 basis point cut is basically telling us the Fed is dovish. Inflation is done, right? Let's take a look at inflation here. I think I have it up. Here we go. Inflation is dropping like a rock. If we look at it on a, let's see where, here we go. Here's inflation, okay? Here's inflation. I'm going to go to the small caps, right? Small caps are right here on the top. Inflation is rolling over. I mean, I don't know what people are looking at. The inflation argument is over. We talked about this all year long. Inflation is going to roll over because it's basically being held up by shelter prices, a lot of contracts, which can't really be recalibrated until, oh, what is this? Breaking news. What are we talking about? That can't be really recalibrated. So now that they're being recalibrated lower because of the demand is down, inflation is falling like a rock. So we're probably not going to get a bounce in inflation until probably mid 2025. We're going to see this thing fall because of those base effects in shelter prices. What does that mean? That, you know, it looks like the Qs are kind of being subdued at the moment. So we look at the Qs. They're going to move up, but not very strong. I think the rotation is here. We're getting that rotation into cyclicals, into possibly high beta cyclicals, right? I think that's what we're going to see. Did the VIX get crushed? Almost. All right, I'm going to take inflation back off. I also want to take off the 10-year. I don't really need to see the 10-year at this moment. Here's GDP though. When I talked, oh no, that's inflation. Here's GDP on a year-over-year basis. Okay. GDP is up. And I know a lot of people don't ever see this. Why do I have Anchor VWAP on here twice? Let's go to the S&P. Oh, I see. Okay. So this is S&P 500. This is what I thought. I thought we'd come down and bounce in this area, then move higher. And it's possible we do. But GDP is moving higher. Okay, right here on a year-over-year basis. This is a little more momentum driven. Usually it's measured on a quarter basis. But when we look at the year to year, we bottom in 2022, right? That's when the bull market pretty much started. And now that inflation's breaking lower, I mean, how can you not be bullish, right? How can you not be bullish with inflation breaking lower and GDP breaking higher? That is a Goldilocks scenario going forward. Now, I'm not under the influence of that the economy is just going to rebound right away. It's going to take a couple months, right? Rate cuts don't necessarily tell you that the economy is going to be great tomorrow, which is why I'm still long bonds. I still think we have some weakening in the pipeline. If it doesn't play out, I don't think bonds really collapse the way a lot of people expect, but I'm very long crypto, and I think that's going to have the biggest bump going forward. Jay Powell comes out in about 5-6 minutes. All right, we'll go back to the intraday. Just wanted to look at some of these aspects. Oil, I think oil's a short. China's rolling over. China's pretty weak. I'm going to take this off. And that's just a retracement. And if you get lower oil prices, that's going to fuel the economy too. So we're looking at October, November. I think November, we're going to see a vicious rally, right? And a Santa Claus rally into the end of the year. That's the expectation. How come that bond is not up? Is that because the market anticipated this rate cut? Yeah, the market was pricing in a rate cut. So you want to talk a little bit about bonds before we come in? Well, bonds are really looking at growth and inflation. If inflation is falling, bonds move higher. Simple as that, right? If inflation's falling from a certain level, bonds can move up. So bonds have been moving up, but now we're at the point where, investors need to figure out, are we headed into recession, right? Do we want to be exposed to bonds or something that can outpace bonds? And what's going to outpace bonds? The cyclicals, right? Consumer, I see DXY dumping. Yeah, the rate cut was 50. Tommy James, or James Tommy, I'm not sure which way it goes. The 50 basis point cut. So they're debasing the dollar basically, right? More liquidity, dollar goes lower. That's how the macro moves. But anyways, yeah, bonds, why are they not moving up? They're trying to catch a bid here, but I would say this. There's no fear of recession. The bonds are moving, the bonds are getting crushed in the last 3 days because industrial production activity is up, okay? Retail sales higher than expected, even though it's still cooling on the longer trend. Manufacturing is up. New housing starts were up. Building permits were up. So economic activity is not dead. That's why bonds are struggling to really, really break out. Bonds are going to break out off of a economy that gets crushed. And right now, we're not seeing that. Now you add on the 50 basis point cut with activity still alive, bonds are probably going to teeter out here. I hope they don't. I hope they go up a little more because the yield on the bond is still pretty attractive, right? And when the Fed actually starts QE, they're going to be actually buying bonds. So I don't think bonds are going to get crushed. I think they're losing their momentum if the economy is not going to collapse. They're going to lose their momentum. That's all I'd have to say about that. Is the market reallocating, selling off bonds and moving into equities instead? They're moving into cyclicals, Ice Blue. They're moving into cyclicals. That's what we just took a look at. They are moving in cyclicals. I think we have J Powell coming up soon. So I'm going to turn that back on. We're going to keep our eye here. We'll see if the market moves up any higher. TikTok did just ban me, though, for showing a video. I guess that's kind of smart. CNBC doesn't want their information shared, so they did just block me from sharing. I see the DXY dumping. Yeah, the dollar's going to dump. Vadim, is it true that the only time they cut 50 is in 01 and 07? Nah, they cut 50 they cut 50 basis points back in 2000, or I'm sorry, in the 90s, they cut 50 basis points. See if we can jump over really quick. I like to use this chart. I got to get better at these charts. Why is it not showing me the rate? Right when I need it, huh? Right when I need it. Now we'll go to the monthly chart. So here's the rates. Right, 90s. Here we go. They cut 50 in the 90s. Okay, I think Powell's up, so we're gonna have to switch over. He's almost up. What, 3 minutes? Yeah, they cut 50 in the 90s. I think right here from 5.8. No, not 5.8. Where is this at? Yeah, no, this was, I think it was right here. No, it might have been over here. I saw the data somewhere. I was just looking at it. I think it was on Twitter. But no, they've cut 50 before. I'm telling you guys, it's all about the economic data. The rate cut is looking at the data. So if the data is falling and you get the data is weakening and the Fed cuts rates, you know, depending on how much they cut is like, okay, the data is getting weak. They're cutting a lot more. They're scared. But today we get all the data, right? We see everything where versus the past, it wasn't the same. It was a little different. So we have a lot more insight. The market catches up a lot faster than the Fed does. So I really think that a lot of the historic data, you got to look at it like with context. It's not necessarily if 50 basis points negative, if 25 positive. It's kind of silly, right? What are the dynamics today? Nothing has worked out this year the way people expected. Everything has been pretty everything's been pretty outside the norm. Oh, no, I didn't want to do that. Okay, so we're going to jump over though. Powell comes out in a minute, so we'll jump over to that. Let me know if the audio is working. Dang, I can't believe they hit me with that. It's crazy. Let me make sure we're all the way forward. All right, I'll turn it on when he actually steps out. So 50 basis point could also be viewed as a red flag. The data is worse and we're getting closer to recession. Very true. It could be, but that is true. That's why it's so hard of a toss-up right now. Is 50 worse or better? I think it's irrelevant. I'm surprised that they did 50. So that does tell us the data is slipping quick enough. Like the risk of employment falling off a cliff is definitely in their purview today. It's definitely there now. It's not like they're like, oh, Powell should come out dovish. He should come out dovish. Market, who knows what the market does? It could sell off for 2 days and then bid higher. It could move up and sell off. All right, I think he's here. But that was a surprise. Cyclicals are definitely moving up. Let's go.
Is now ready to speak. Let's listen.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up, but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished, and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you were thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed that made the committee go 50? And how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. So we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
How do we make sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members rather of the committee are thinking today, assuming that their particular forecasts are realized.
Hi, Chris Rugaber at Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher than thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect in the base case to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that. And that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%. Inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment moving to a more sustainable level. So that the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
Howard Schneider with Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open. And I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of division, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of them wrote down 3 or more, and 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that. Now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this to be running every other meeting once we get into next year? For example,
we're going to take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but and I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Hi, Chair Powell. Gina Smilik, the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So again, the labor market is actually in solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Sorry, Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions there. But so I would say we don't think we're behind. We do not think we think this is timely. But I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
So I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut, many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably down to 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, "Oh, this is the new pace." You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on the balance sheet. In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Thank you. Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply? Or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. Meant by many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018, 17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
And just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So that's our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that, and we're not hearing that from
utilities and staples are strengthening versus bonds for the defensive trade initially. So the market doesn't believe we're headed for a deep recession, as he said, just a slowdown.
Is when it's strong, and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
Michael McKee with Bloomberg TV and Radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year, 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So, and policy we think is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment, and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with disinflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's, we're right adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be, wage increases rather are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is. So we feel good about that. Vacancies over, per unemployed is back to, but it's still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person as measured. It's now below around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, I could go on and on. There are many, many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change particularly over the last few months. And, so what we say is as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
And what do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
More data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting, I think. Or no, on the Friday before the meeting. And inflation data. We'll get all this data. We'll be watching. It's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Hi, Chair Powell. Neil Irwin with Axios. We've only been running a little above 100,000 jobs a month on payrolls the last 3 months. Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise. And the other thing is just a slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I think it's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
Thanks, Chair Powell. Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5%, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate. Now, some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question, and you mean after we get through all of this? It's just a great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So there was people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But, honestly, we're going to find out. But it feels to me and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. It's, again, we only know it by its works.
One more. How do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
Yeah, so this is my fourth presidential election at the Fed, and it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve, and we do that, and we make a decision as a group, and then we announce it, and that's always what it is. It's never about anything else. Nothing else is discussed, and I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind. And, it's something we all take very, very seriously. We don't put up any other filters. I think if you start doing that, I don't know where you stop. And so we just don't do that.
Thank you, Chair Powell. I'm Jolene Kent with CBS News. My first question is very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
I would just say that, the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation. The goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is? Yeah.
So housing inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels, but they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this, but, the direction of travel is clear. And as long as market rents remain, relatively low inflation over time, that will show up. Just the time it's taking now, several years rather than just one or two cycles of annual lease renewals. So I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. They all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more. What's the likelihood of that, and how would you react to that?
The housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home. So because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not, obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to find, to zone lots that are in places where people want to live. It's all of the aspects of housing are more and more difficult. And, where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria. Hi, Victoria Guido with Politico. Just following up on some of the labor market talk earlier, monetary policy operates with long and variable lags. And I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy basically fine. If you talk to market participants, I mean, business people who are actually out there doing business. So I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but we might well have. I think that's not, that doesn't really answer the question that we ask ourselves, which is, let's look, when at this meeting, we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy stance we need to move to? It's clear that we clearly, literally, everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the paths forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Thank you, Chair Powell. Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time, as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high. What do you say to those households?
Well, what I can say to the public is that we had a burst of inflation. Many other countries around the world had a similar burst of inflation. And when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant, but at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. We just keep it low, keep it stable. We're restoring that. So what we're going through now really, it restores, it will benefit people over a long period of time. Price stability benefits everybody over a long period of time, just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on. And I think we've made real progress. We don't tell people how to think about the economy, of course. And of course, people are experiencing high prices as opposed to high inflation. And we understand that's painful.
Hi, Chair Powell. Greg Robb from MarketWatch.com. I was wondering if you could go through, you said just at the beginning that coming into the blackout, there was like an open thought of 25 or 50. The Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, could you talk, would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? After the CPI number came out, it was a really small probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line. It will be, the unemployment rate's very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting, we'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about, is our policy stance where it needs to be to foster over the medium term our mandate goals. Yeah, so I can't say we have a bright line in mind.
Thanks, Chair Powell. Matt Egan from CNN. I know that you discussed earlier how the Fed does whatever the right thing is and nothing else factors in. But in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so important?
Sure. So countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea, is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public. And I hope and strongly believe that it will, continue.
Kyle Campbell for American Banker. Thanks for taking the questions, Chair Powell. A couple regulatory developments in the past week that I want to ask you about. First, last week, Vice Chair for Supervision, Michael Barr, outlined his views for the changes to the Basel III Endgame. I'm wondering if you are in alignment with him on what those changes should be, if those have support on the board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators.
You know what? Hold the second question.
Okay, sure.
We'll give you the second question. So the answer to your question is that, yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is, that's happening with my support. That's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then the comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
And then yesterday there were merger reform finalizations from the other bank regulators. What does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today. Thanks.
Jennifer for the last question. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. Even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. There was a severe labor shortage. So very hot labor market, and we had inflation way above target. So that said to us, concentrate on inflation, and we did for a while, and we kept at that. That the stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activity. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today I think we made a good, strong start on that. I think it was the right decision, and I think it should send a signal that that we're committed to coming up with a good outcome here.
Vulnerable to a shock now that could tip it into recession?
I don't think so. I don't. As I look, well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of of a downturn is elevated. Okay, I don't see that. You see growth at a solid rate. you see inflation coming down, and you see a labor market that's still at very solid levels. It's so I don't really see that. No, thank you.
Okay, that was Fed Chair Powell. Following the decision to cut interest rates by 50 basis points, perhaps a bit of a surprise today. Chair Powell saying moments ago, you heard it in the news conference, that there is greater confidence that inflation is moving closer to their target, that the labor market has cooled, but that the economy remains strong overall. Important to note, too, today that there was one dissent from Governor Bowman. That's the first from a position of that stature since 2005. Stocks have been a bit volatile following the decision. We can take a look now. We are higher across the board.
All right, let's go over the macro. Let's take a look at the charts and see what the market is doing at the moment. And then we'll go over, kind of where the economy is, what things are looking like economically. Got some of those charts up too. Liquidity. Where's liquidity? Financial conditions. All right, let me pull up. Let's go with the economic activity. Should we go there first? We'll go there last. We'll stick with the charts first. All right, I'm gonna go ahead and pull up the charts a little bigger. There we go. Let's get back to this mode. All right, S&P dropping. So we got the 50 basis point cut. Where'd it go? I guess I put it somewhere else. Oh, there it is. The surprise 50 basis point cut. I know some people maybe weren't surprised, but that was a surprise for the market. And I think we saw a short squeeze initially, or the, unpositioning of the shorts at first to, and then a digestion of what does that mean? So far, nothing. We have nothing. What up, Hassan? How you doing? So far, there is no clarity. Now, what this tells me with the S&P 500, okay, we short, better than expected, initial pop, and then consolidation. As he speaks, he's saying, look, we need to cut. If we don't, things can get worse, but the economy is stable. So he's playing middle ground, right? Playing middle ground. And the market's going to he's telling the market, look, you need to watch the data. We're not going to tell you what to do. We're not going to tell you what's going to happen or what our next move is. You need to watch the data. The Fed wants the market to decide, right, based on the data, to be a more efficient market, not based off what the Fed says or does. But the 50 basis points does tell us, hey, look, if we don't do something, then the economy is falling apart. Counter to what we've been seeing over the past, 3 days of data this past week, which is higher production, right? Not a reacceleration of production, but a better than expected, right? So the economy is, the data is coming in better than expected, but it's still cooling. So he's saying, look, even though it's better than expected, it's going to decelerate pretty quickly if we don't cut rates. So they got that 50 basis point cut. Now the balance sheet, he's going to continue to reduce the balance sheet. Although that's kind of irrelevant because we see liquidity still coming into the market. It should, with the rates down, it should increase liquidity. And we'll go over that. Ice Blue, what up? Nvidia's dropping. Do we buy the rumor or sell the news? We'll go over that. We'll go over Nvidia. We'll take a look at it. I just want to show, look, 50 basis point cut. The market has not decided. Let's go sector to sector so you can see what is actually happening. Okay. At the moment, the dollar should be breaking, but it's going higher. So the dollar saying, right, if they're increasing liquidity, if they're cutting rates, the dollar should decelerate because it's an increase in supply of US dollars. Lower rates equals more credit, right? More ability to borrow for companies. That's immediate, starting tomorrow, probably starting today. But the dollar's climbing because it's signaling, well, hold on, is the economy going to tank? This is a risk off, recession move from the dollar. It's 1 day, it doesn't mean much, okay? Bond market. Initially sold. Oh, the bond market is getting crushed. All right, I didn't even see this. So bonds are getting crushed. Now, this was the interesting thing to me. Bonds are the number one, other than the dollar. Okay, number two risk off asset. The dollar's number one because that's a very bad risk. Bonds are more of a okay, not everything's collapsing, but it is a recession. Growth is decelerating. We're headed for recession. Bonds are not pricing in recession, which is so weird versus the dollar, right? But dollar could be, who knows what the dollar is doing? The dollar is a lot of factors. Bonds are saying, look, this is not an imminent recession, although defensive sectors are kind of bidding up a little bit, right? I see the cyclicals, the market hasn't decided, but the cyclicals are trying to move up. Also, IWM is part of that cyclical nature. IWM went up strong, right? Small caps exploded, came back down. So the market is still digesting what the hell is going on. We're going to go versus S&P, okay, to talk about this. Then we'll hit individual charts. So let's go ahead and start with the Qs, right? Qs versus S&P. Initially, the Qs, I believe, what is this? It came out at 11, right? So when the rate cut hit, the Qs strengthened, and then the Qs got crushed during the meeting. Maybe they strengthened back up. We don't know. No decision there, right? Communications services, it's more of a quality, right? Consistency. Nobody's buying that anyways, right? You got Meta in there, but those are kind of more mega caps. Energy bursted higher at the beginning of the day and then just traded sideways, hasn't decided. Building materials exploded, or materials in general, very cyclical, right? They exploded at first and then they sold off. So undecided, but we do know the rate cut helps them. But with Powell's rhetoric, he's saying, look, we need to cut rates, things are decelerating. We need to wait for the data. That's the truth. The data. Now his tone is suggesting, he talked about he said, hey, look, we got a lot of jobs, we got a lot of labor from the border, right? And even those jobs are weaker than expected. So he's really, with his rhetoric, what he's really telling the market is, look, the employment picture is weakening quickly. And I think that's what the market is responding to after the rate cut. It was like, oh, great. And then it's like, okay, wait a minute. Is he saying that the labor market is worse? Which puts the burden of evidence right back on the data, which was why we track the data. Industrial, same thing. Nothing's going on here, but we do see defensives. This was XLY, consumer discretionary, right? The leisure stuff, the stuff that you really got to spend your income on, right? Not hospitals. What is it? Boats, not boats. What the hell am I saying? Cruise ships, right? Gambling stocks, stuff like that. Stuff that you go spend your excess money with exploded, rate cuts, and then it came down, right? Home builders, same thing. Real estate, pretty much the same thing. So everything just popped up, came back down. No clarity there. Financials are sticking up a little more after the speech. Small caps, we'll see what small caps do. They do benefit the most. Biotech and financials. Semiconductors, interesting. Semiconductors were moving higher at first, and then they just sold off. Okay. Bitcoin strengthening. Let's go. This is pure liquidity. You think Bitcoin gives a damn about a slowing economy? No. Bitcoin is moving higher, and this is my number one pick. Not Bitcoin, but crypto in general. All these cyclical companies, yes, they want rate cuts, but also they risk a slowdown in consumer demand. Bitcoin does not have consumer demand. It is pure liquidity. If liquidity continues to increase, right? Coming from the central banks, the commercial banks, lower interest rates, crypto moves higher, period. Plus, we're going into a period of losing, less supply with demand increasing, more government stimulus going forward. So crypto may be the strongest asset at the moment. Okay, I'm trying to check. Yeah, versus everything else, at least for today, right? Bonds surprisingly getting crushed. Now, this is interesting because we're going to look at bonds here. Bonds lead the defensive sectors, right? Bonds growth is falling apart, so we're headed higher, but bonds are falling. So bonds are saying, wait a minute, growth is not falling apart, not yet, according to Fed Chair Powell, but yet we get investors coming into cyclical defensive stocks. Utilities first sold off on the rate cut, and then they recovered. They're still below VWAP, so maybe they don't fully recover. But defensive stocks, utilities up, consumer staples rebounded also, and then healthcare. So we don't know. There's no trend here. There's no clarity. But what we do know is investors are just not sure. I think it comes back down to the data. I still think crypto and small caps have the biggest outcome going forward. I don't think we're going to see a recession. Bonds are telling us that. I think it's just, some people are defending themselves. I was bullish on bonds if the data continues to slip, but that 50 basis point cut may have just put the nail in the coffin for the recession trade. They're not going to allow it to happen. They're not going to allow the recession to happen. Not to say, they have full control, but they are cutting pretty strongly. So the S&P, hey, is going sideways. Now let's go look at some individual stocks. Okay, the VIX is nowhere. We'll see. We got the rest of the week, 2 more days to see how the market starts to digest the noise. What is the economic data we have going forward? And I'm going to get to your comments. Keep in mind, look at the data has been stronger than expected. Tomorrow we have initial jobless claims, and Powell said, look, they're not really falling apart. The economy's still stable. It's slowing, but it's still stable. Nothing negative. We got Philadelphia Fed Manufacturing Index tomorrow was negative before. So a whole lot of market activity things going on. Existing home sales, those are probably bid up. I'm thinking the economy in certain sectors is going to start strengthening with the rate cuts. We'll see. So we'll see what the market actually says about the data going forward, right? We don't know. Let's see. Ice Blue, I appreciate it, man. Thank you. Thanks for the love, man. Thanks for staying. I'm trying to give you my best out. Hopefully I'm useful. That's all I can say. My other account is, your resonance. Oh, okay. What up? And I'm done with your resonance. I'm done. I think it was you. I'm not sure. I'm done with the first course. I'm pretty much done with it. We're just making sure that it works, right? It was built purely from scratch. And this one, there's going to be some other courses. It's not going to be all in one. I want you to be able to choose. This course is going to be macroeconomics mostly for beginners. If you're already very, have a lot of skills in macro, you're probably going to be like, oh, I kind of know this, but this is more beginner from very beginner to, what does the Fed do? Literally talking about policy here, right? What does policy mean? Fiscal policy, all liquidity, all that stuff. All right. So I appreciate it though. September is usually not a good month. October, November will be better. Yeah, I don't think we get full clarity in markets until the election's over, or we get close to the election. That's what happened in 2016. 2020 was irrelevant. That was a pandemic. You got full stimulus, so that was not a normal business cycle. But 2016, when Trump got elected, boom, markets exploded, right? So I think we need November. I think September can still be rough. We'll see. We're looking at all this all-time high, right? This was an all-time high. We haven't got above it after the meeting. So I think the next 2 days and then over the weekend, if we can't get above the all-time high, I think we're going to cycle right back down, right? 50 basis point cut, great for the future, but in the immediate term, well, damn, we better get good data. I think the market is saying this. We need to see the better data to price in the rate cut as being productive. If the economy is falling apart too quickly, bonds go up, consumer staples, right? Healthcare, utilities, they move up higher. And we'll see how that plays out. I think tech is going to recover eventually. The Qs, still have the most pricing power. It just comes down to when investors think it's going to be as valuable. So it's all about the data. I think it's all about the data as usual. How we're not going to go over economic activity. I'll just say it like this. Retail sales, okay, still slowing. Industrial production is showing some signs of recovery. ISM showing signs of recovery, but in recession territory. The manufacturing sector anyways. ISM services are still positive, barely. Okay, barely. So we can't get a growth shock. We can't get any shock in the economy. And with oil prices dropping so low, I think this is constructive for the market. Again, going over the long term, it does signal a slower economy, but it also says gasoline prices should be coming down. And if this continues, the demand falls, you get lower gas prices. Yes, it's a slightly weaker economy, but it's constructive because the price of energy is lower, and I still see a bull run in November no matter what, right? Without a shock. Non-farm payrolls look the worst, okay? They are falling apart. So how much gig work, how many gig economy jobs that are not on the payrolls are actually showing up? We don't know. We can't track that, obviously. So we look at the spending. But new home sales are starting to bid up, okay? Building permits building permits today, I think it was today or yesterday, saw some constructiveness, right? So looking good. So I think choppiness, I think we're going to look at chop. Investors are undecided until we hit November. More chop. But guess what? The Fed's cutting. That's positive for risk assets and cyclicals into the future. All right, Isan, that's all he has been saying all the time. We're going to look at the data to decide what to do. Yep, 100% looking at the data. I don't put my excess money to boats or cruise ships. I'll put it into crypto. Yeah, a lot of people don't like crypto, but crypto only moves like 10 times a year, according to Tom Lee. It doesn't really trend higher. It just explodes. And when it explodes, it moves. And I think that's what we're going to get at the end of the year, right? I thought it'd be summertime, but we got the big move in the early year, right? January, February, March. We got a pretty sharp move. Bitcoin's still the best performing asset of the year. asset class. Okay, not asset class. And at the end of the year, it probably goes higher in my view, easily. All right, your residents, looking forward to it. Have micro from the university. Macro. Okay, nice. Okay. Yeah, you're gonna have to let me know. I make sure that my biggest focus on the course, just is that it is interactive. There's quizzes attached to it. It's easy, it's simple. There's visuals, it'll keep your attention. I don't want it to be boring because you can't learn when things are too boring. September is usually not a good month, 100%. I'm looking forward to your trading course. Yeah, trading will be interesting. I'm also putting that together. That's going to take some time, one at a time. These are all by hand, right? I'm not copying nobody. I am not using a course online. We created everything by hand, even the website, all the coding, everything. So it's going to take some time. Anyways, back to the market. Let's see what we have in play. So TLT, okay, I've been bullish on bonds. We'll see. Okay. We're really going to need some weakness in the economic data going forward to get bonds, to keep this bond momentum. We're going to need weaker data, right? No, nobody wants to say that. Oh my God, but forget it. If you're long bonds, you want to see weaker data. Thoughts on Tesla? We'll get to Tesla's kind of weird because yes, rate cuts increase margins, but they've had so many positives for, they've had so many, tax credit cuts from the government. The rate cut might not even make a big difference at all because they've already used cuts from the fiscal policy, right? And those, what do you call them? Subsidies, whatever. So Tesla, I don't know. Tesla's going to come down to the story. Do investors believe in the story, and do the technical support a breakout? I think that's when it comes to Tesla. We'll get to Tesla. Small caps, really strong in the last couple of days. I think they go higher. They still have not made a new high when it comes to the entire market. Wait, should I come to this one? Let's go to this one. Let me switch it up a little bit. Lost the momentum. Small caps. Here we go. So yeah, here's my charts. So small caps have not made a new high, right? They still have some 244 as a high. Today showed you that the last couple of days showed the strength. If economic growth, right? And let's put it in this macro season. If economic growth continues to, beat expectations and just slow, then small caps are going to boom, right? Maybe you have one more pullback around this level. Who knows? You're trending higher in small caps. They probably boom because they're very interest rate and cyclical sensitive. Well, they're cyclicals. They're very interest rate sensitive. And you see a wedge forming at the top of this long consolidation. So small caps should do well. What crushes small caps? Some type of shock that destroys, and they're already cutting rates. So I don't know. I don't think so. Some type of shock that really scares the market will crush small caps. Carry, same thing. It's part of the small caps. Home builders at all-time highs. I don't like home builders. Yes, they've been leading the market, right? Home builders are the leading cyclical sector, making all-time highs, but they're overdone. I think they're a little overdone. I would look at another cyclical sector or stock that falls within the cyclicals, but is not, the momentum's not overdone. Is it completely overdone? No, but this is a classic bearish divergence, right? You got the momentum slowing and you have the stock moving higher, right? So I don't like this. I wouldn't like home builders at the moment. Yeah, DR Horton is moving up. Okay, but they're pricing in rate cuts. They've already priced in rate cuts. I think home builders, maybe not real estate, but I think the home builders need a pullback. Maybe not this one, right? This one's not overdone yet, but a lot of the home builders, I think they've already priced it in. So I think they're going to lose their momentum. We jump over to maybe not Home Depot. Home Depot still maybe has some room. We'll see. I think Home Depot is it's a categoric home build. It's not a home builder. It's categorically in the cyclicals with real estate, building and all that, but it's more of the consumer. And I think Home Depot has more of a chance. I really like Caterpillar as an industrial. Okay. Going 6 months forward, the government's going to spend money. Okay. They're going to spend big. You can see this pattern really starting to form for Caterpillar. It's been consolidating at the lows. The momentum is not falling too far. And I think Caterpillar is really going to run to 400. pretty soon over the next couple months. Maybe it takes a while, but as long as these technicals are showing a constructive move, I think Caterpillar breaks out. I like Caterpillar. I like this Copper Corporation. Okay, Copper should be, now this is if China doesn't completely barf. Now, who knows what the Chinese numbers are? You can't trust anything they say. When they talk, they lie most of the time. Just like Russia. When it comes to economic data, right? They want to save face. We can't trust the numbers. So we just watch copper demand in general. As soon as this breaks out, right? This is a SECO. This is not copper. This is a subsidiary, not subsidiary. This is a proxy to copper. It's a copper company. You also have ETN, or is this an industrial? I think that's an industrial. But you also have Freeport, McMoran, all them. But I like this company better just because of the technicals, not necessarily the company, right? Industrials, again, I think they're going to do well. Here's Freeport, McMoran. Looks good. Looks good. Looks like it's recovering. Now you got rate cuts. All right. Now, when it comes to utilities, the defensive sector, CEG, this thing's already moved up a lot. CEG, a lot of data center demand. This story is going nowhere. It's a secular trend. Data center spend is like they're trying to build so many data centers, a lot of electricity, go straight to the utilities. And this one's in Virginia, high growth prospects. There's probably others, but that's what I'm looking at the moment. Meta, I like Meta. I think Meta, you go into recession, Meta's still fine. It's more of a high quality growth. It is growth, but it's quality growth. Strong balance sheet, no low debt, right? A lot of assets, a lot of income, especially for advertising going into the end of the year. So Meta, if you're going to look at a mega cap, I like Meta. I like Amazon also. Maybe not Google as much, but I like Amazon. Still hasn't made all-time highs yet. And we're headed into what? We're headed into Santa Claus rally season. So a lot of people ordering online. Walmart crushing it too. Now we look at some of the semiconductors. I think you need time. I think semiconductors really want to see if Trump is elected or if Kamala's elected. I think they want to see some clarity on the tariffs, right? The chip tariffs, which will destroy the revenue if the tariffs really crush them, at least for a cycle. So they could come lower. I'm not long yet. I wouldn't be long yet. Maybe some spreads, right? Maybe some spreads on NVIDIA. NVIDIA might be another monster. I don't know. But maybe some spreads on the chips. Okay. ELF absolutely destroy. I think it's oversold. I think ELF is oversold. I'm not saying how to trade it, but I would sell puts down here, month out, 2 months out, 45 days out. I think it's oversold. Celsius, same thing. They're finally becoming very oversold. You can see the momentum starting to pick up. I think there's also, I should have had in here SMCI and Intel. I should have added those oversolds on here. Looks like Chipotle is starting to recover. Okay, this is a consumer discretionary stock, so part of the cyclicals. Okay. CrowdStrike, if it breaks out, it looks good. I don't know. We'll see. I need to add Intel on here. INTC. It had a nice gap up, but there's a strong bullish divergence for Intel. You can see momentum's picking up, and once you clear 22, which it tried to get above, you should be straight. They're getting a government contract to keep rebuilding. Thoughts on Tesla? I'll get to Tesla. How about renewable energy? Renewable energy, good question. I'll go look at the Robinhood about to break out. Palantir on absolute fire. It pisses me off because I missed out a lot on this. Thing is on fire. I got long here, got out way too soon. I want to pull back. Palantir is one of those stocks that I think it's like the next NVIDIA, not today, but in the future. So any pullback, I would be more invested in this than trading it. Palantir can easily be a $500 billion company in my view. Let's see. Thoughts on Tesla? How about, okay, I keep reading that over and over. Let's go back to coin. Well, crypto is going to break out. Like coin's almost oversold, could have another slip. But I think crypto is the next big move, right? Not too dependent on the economy, dependent on liquidity, which as economy slow, as you go into recession, liquidity starts to move up. SUI and Solana. Let's see. SUI. This is the chips stock, right? Oh no, I don't know what this is. Sun Communities. What is this? Finance real estate. Okay. Yeah, if this is part of the real estate sector, you can see the recovery, right? pricing in rate cuts. Still at the lows, not fully. I mean, the momentum maybe is a little overdone in the short term, but they're slow movers. I like it. It's above a strong technical level. So I like it. Solana, of course, is part of the crypto. Sol USD, no? Yeah, Solana is part of the crypto theme. It's gonna boom. Yeah, Sol's gonna boom. Very nice, holding the level. I mean, when you hold the level this strong, right? I like Chainlink, but hey, Solana is holding technically very strong. The heck is this? How did you join yourself? That's weird. I thought I would have to accept that. Anyway, Solana's moving up. Okay, renewable energy or Tesla, my bad. Let's go to Tesla. Look, Tesla needs the story to come back pretty much, right? This is one of the biggest secular trends you can think of when you go back. Okay, Tesla's a strong long-term trend, but it needs the story. It needs momentum. It needs a positive story. And there's so many things going on with Tesla. It's not going to fail, but you know, people don't have a whole lot of confidence in Elon because of the politics, because of X, because of who he supports. If Trump wins, I think Tesla explodes. Simple as that. So it needs some catalysts, right? We'll see in October, the AI day, how it does, right? Usually Tesla sells off. So I wouldn't even doubt if it runs up and then sells off. But I think Tesla needs a story. It needs a strong story, and we just haven't got it yet. You asked about renewable energies. Are they ready? Let's take a look at renewables. I think I got them on here. Renewables. Here's clean energy. I mean, they're getting crushed. I don't know. I don't trust renewable energy. I just don't trust it yet. As a sector, if you're a big company, because here's the thing, ExxonMobil, right? ExxonMobil, these oil and gas giants, guess what? They're investing in renewable energy. They have a lot more resources. They have a lot more CapEx, and they're pretty much eating up these industries. And I'm not saying the industries are going to die. I'm sure there's some good stocks. I'm just not aware of them. So CVX is another one. These big oil and gas giants, they're basically just dipping their toes in the renewable sector because they know they're going to have to switch, and it's hard. So I don't know. So you got PBW, you got TAN is another ETF for renewables. This is solar. Oh, this is solar. Okay. Yeah, I think you need lower rate cuts and more liquidity. The Fed is still reducing their balance sheet. Let's go Fed global net liquidity. So when you get global liquidity step up, then maybe those high beta renewable energy asset classes move up. But for now, I don't know. So this is just global liquidity still needs to break out, meaning you're getting more collateral, you're getting more reserves in the banking sectors of the world, right? And they're going to send out loans like crazy, and we're just not there yet. Even though rates are cut, we still need time. So I think we're at the beginning, but I like crypto better. I just like crypto better. There's a lot of stuff out there, and I would just stick with crypto. No, you're good. I don't think it matters in the long run who's in the White House. No, it really doesn't. It really, when it comes to markets, it'll give you stronger or weaker sectors, but overall, they're still headed higher. I think crypto definitely does better under Trump. I mean, from what he's trying to do, it can definitely do better. But you never know. Maybe the tariffs mess up the economy, and you never know. But ideally, what he's trying to do with Bitcoin should prop crypto up a lot higher. In the long run, you're right. In the long run, it's going up. What's going to go up goes up. Technology will be adopted. Maybe for a trade, things change. Let's see. We got what, 10 minutes left. I want to see what's finishing off higher or lower on the day. So let's dive into. Let's see. So this is what I have drawn out. I don't know if it happens. We'll see. We're post rate cut. We've We've already held that anchored VWAP. We could go as low as this anchored VWAP for the S&P. Let me take this off. Momentum is waning though. Okay. Momentum on the RSI, relative strength is not exceeded. Now we still have, you really want to wait, what, 2 or 3 days after the rate cut, after an important release to see how the market digests the data. And if this doesn't turn up, I think we're going to come back and retest 540 to 530 for the S&P. Right? I'm a little biased. I'm short the S&P still, so I'm a little more biased. I'll admit that, but I think so. TLT, I'm biased to the upside, but who knows what happens if we have weaker data? Then this trade should work out. You never know when to actually flip. Okay, so S&P losing momentum a bit. On the weekly chart, same thing, right? Lower highs on the RSI. And if we don't get that burst higher, I think that's it. I think we're gonna have to come back down, meet some levels. The Qs still pretty weak, trending lower, but I think the Qs eventually after November, I think the Qs will rip. Tech is tech. Tech will still perform. It's just gonna take some time, right? But the Qs don't look bad. All right, I'm gonna look to see if we don't have any more comments. Even people are in crypto think Trump's projects not good for the market. Rug pull warning. Historically, the market has performed better when the Democrats have been in power. Oh, yeah, I see a lot of counter. I see so much data back and forth. I don't even think it's clear. I've seen when Republicans own the House and the Senate, but then when there's a Democratic president, so it's whoever spends more money, I think. You never know. These last couple of years have been unprecedented, right? Yield curve inversions, no recession, unemployment low, very low. It's just been, take it with a grain of salt. I would say take everything with a grain of salt. All right, I'm gonna look at the internals really quick to see if there's any signal going into the close of what markets are looking to do. Okay, these are all versus S&P. Q's weakening versus the S&P. Communication strengthening, so that's like a safety play, quality play. Energy consolidating, no sign. Home builders, take this off. Home builders, not home builders, but basic materials weakening, no signal there, nothing. Industrials, bro, where's the? Why does this not have a? That's weird. Huh. Oh well. Industrials, nothing really. Consumer, discretionary, very cyclical. Came up, came right back down, no signal. I guess the same. Energy, I mean, oh no, this is real estate. Real estate, pretty nice rebound. Financials, okay. Financials are giving us a signal. Okay, financials early in the day, strong, coming up. Financials are ripping higher. I'm sure IWM's up because a lot of it is financials. I guess not. SMH, semiconductors making new lows of day. So rotation out of semiconductors. It looks like the cyclical names are coming back. Those tied to interest rates. Bitcoin lost momentum. TLT maybe comes back a little bit. Utilities recovering. Staples trying to recover. Healthcare, whatever. Okay, so financials, we'll see. We'll see how financials do. Not just financials, but where the market's trying to rotate, right? Where is it trying to rotate? S&P is definitely trading lower on the day. And we'll see what happens. Let's see what else we got. Who was office when crypto started? When crypto started, it was Obama. It was Obama. But I think crypto isn't really tied to the fiscal as much as it's tied to the central bank. It's more of a monetary response, right? Debasing the currency, crypto goes higher. Lower interest rates, crypto goes higher. That's what I think. Did you expect the Qs to rip after 5% cut compared to 25? No, from what I've been seeing, I didn't really expect the Qs to rip unless I don't really see the Qs ripping at all until the positioning rotates out of tech completely. If you get a sharp sell off in the market, I think the Qs could come out of it stronger and start leading again. But I think they're still rotating out of the Qs, in my view. He says priced in. Yeah, I think a lot of stuff was already priced in, especially ITB, especially the home builders who've been on a tear, right? Home builders have been on a tear. And what are they tearing up? They're pricing in rate cuts. It's not sustainable momentum, at least. It's not sustainable momentum. Maybe they'll stay higher, trend higher, but not sustainable momentum. Small caps, I think, are going to gain momentum, right? Small caps are not even at all-time highs. They're still under-owned. Still a lot of short squeezy. KRE is the regional banks, and the short interest on regional banks is extremely high. So KRE could probably move higher. User one says, let's see what user one says. Just manipulated moves up and down. Nothing, no worries. Today doesn't define the next 10 days in the market. 100%. Yeah, 100%. No real signals other than I mean, I think it doesn't give you definite, clarity, but I think seeing the Qs really sell off and seeing semiconductor sell off tells you there's more pain for the semiconductors, and we can add more variables to that, right? Trump tariffs hurting tech, well, semiconductors to some degree. Nvidia earnings very sensitive to the market. So I think semiconductors are going to have to wait for a while to find a bid. Cyclicals are going higher. We're seeing that. And defensives, it's between cyclicals, defensives, but growth tech is still subdued. I think that's all. Nothing's really changed other than, wow, the Fed is really trying to save the market. Also, bonds losing momentum. We don't have any big data over the next week. The big data doesn't come out till, see, the next biggest data we have, housing. Maybe next week we have housing prices. And the rate cut's not going to do anything. We're not going to see anything for a couple months. But inflation is coming down, so that's a positive. Yeah, nothing really. We got GDP the 26th. That's not even next week, is it? I guess so. Yeah, we got GDP at the end of the week next week. So, second half of the week or going into next week, we don't have anything till the second half, right? Other than that, I mean, I think crypto's the trade. I think crypto's a trade for the next 3 months, at least 3 to 4, 5, 6 months. I don't think anything outperforms Bitcoin. If we see the dollar easy signal, if we get the dollar really roll over, that's a sign of the global economy starting to reaccelerate, simply because the dollar is a proxy for global liquidity, right? Lower dollar means other countries, their currency strengthens. Right. Therefore, they can do more financing. So when the dollar's up, it tightens the whole globe. When the dollar crushes or falls, it's a sign that the global economy should be picking up exports, imports, and risk assets. So it looks like it wants to roll over. And we have low oil. Inflation's down. Who knows what happens in the short term? I think we have a rocky October. What do we got? We got about, yeah, we probably do. There's a lot of political stuff. I'm sure it's only going to accelerate. We'll see what happens in the Middle East, Ukraine, Russia. You never know, which is why I'm going to keep long bonds. I'm going to stay long bonds. We're climbing higher, but you just never know if a shock comes. I'm really long crypto, but you never know what happens. What could happen geopolitically in these times of the election. So we'll see how things play out. Other than that, I'm done here. You guys stay blessed. Stay tuned. I'll be sending out, I think in October, by October, we should be ready with the course. And it's one of many courses coming. If you're unfamiliar, just stay, tuned with the content. Anyways, you guys, hey, stay healthy, lift weights, right? Keep learning every single day and stay blessed. We're going to have lower PPI next month since gas is getting lower. Probably. Yeah, energy coming down. That's constructive. So I'll catch you guys next time. Like I said, stay blessed and we'll see what happens.